Welcome to our training video. Today we have a question. The market has been in a huge volatile downswing, and is the bear market, bull market over? Are we in a bear market? Various experts will tell you one thing or the other, which is the way it always is at big turning points. You line up 10 forecasters and you get 10 different answers. But how do you know? And I want to know, at least again, based on probabilities, when we are in a bull or a bear market. That's the million-dollar question, is it not? For retirement funds, qualified retirement accounts, 401ks, 401bs, IRAs, SEP IRAs, the whole 9 yards. Should you go to lighten up on stocks, go to cash during a bear market? Well, sure. Well, how do you know when you're in one of those? Let me show you a very simple way to determine that. Here is a 20-year chart of the Standard & Poor's 500, and it's a weekly chart. So a 20-year weekly chart of the Standard & Poor's 500. It has a 30-day moving average on here, which is a fast-moving average, and it has a 65-day moving average, which is the slower moving average. And very simply, when the fast moving average crosses the slow moving average, it indicates we are beginning a bear market, and that occurred right there. Would this have been a good time to, this was the dot-com bomb in 2000. Would have been a good time to go to cash or sell your long positions, whatever. A nice little consolidation entered there. So this gave us plenty of warning, and down we go. Now, about 3 years later, in 2003, which is kind of the typical length of a bear market. Bull markets are longer than bear markets typically. But here we had a crossover in 2003. Indicating a bull market was underway, and here we go. Oftentimes, the 65-day moving average will act as resistance if the candlesticks are below it, and support if they're above it. And that was a nice long run. Is this the end? Is this the end? We wait until these lines cross, and it tells us right here. This is when a bear market started. This was 2008. Maybe some of you remember that. Let me make the chart larger. What if we would have gotten out, right in here? The panic that people experience when 30, 40, 50, 60% of their account or their investment funds disappear it can be traumatic. Well, when do you get back in? Typically, you don't have a V bottom like this made. There's a little bit of a head and shoulders here. But this tells us we're back in a bull market. We could have entered there. This was an indication that this was going to continue. We could have entered there, and up we go. Now we got a false signal right there. They crossed, and so let's say we assumed we were in a bear market, so we went to cash right here. Well, it crossed above right there. We could have gotten back to stocks. We would have lost that. Not a fatal move by any means, and then we take advantage of all of this. You see the 65-day acting as support there. Here's another false signal, and this was an unprecedented bull market, so it might have acted more strangely. This was 2 false signals in 20 years. That's a very good record. Here, it drops below. What if we had gone to cash there and back into stocks there? We would have lost this, but we would have gained this. Now, if we get out and it's a legitimate bear market, we're going to save a lot of grief as our investment accounts, disappear, or a lot of them, a big percentage of them disappear. Buy and hold works, and this is why it does. Stock market always makes new highs. and away it goes. But if you can get out when the bear market starts, you're miles and miles ahead of the game. You can see these moving averages are starting to converge. We actually have kind of a double top here. We had a trading range for a while, and then it fell out. When this crosses over from above, that would confirm to me that we are definitely in a bear market. Now I say definitely because I guess that was the wrong choice of words. Probabilities are high that we are in a bear market. So I hope this is helpful. Use this to, you don't want to trade your 401k or IRA or whatever, in and out of stocks, in and out, in and out. But every few years, when this starts to make a turn, it might be advantageous to you to kind of lighten up on stocks, go heavy on stocks, lighten up on stocks, go heavy on stocks, lighten up on stocks, go heavy. And it can be a very good indicator. So I hope this is helpful, and I wish you the best in your trading as always. And hopefully we will speak soon. Thank you.